Time to wake up money. Unemployment rates are at their highest in decades, and many Americans are facing the first tax season without a job. Now, if you have or happen to be one of them, how can you make sure that you don't make a move that can actually bring about a big bill later? Well, here to help us avoid common tax pitfalls is Biz Radio's senior analyst, Kaleta. Good morning.
Good morning.
A lot more people, unfortunately, are unemployed, right? So they got the unemployment coming in. You say that there are some important things that they have to be aware of. One is to have federal withholding deducted.
Well, if you're not unemployed at the present time, but there's chances that you may get laid off for a short period of time, be prepared today by withholding at least one exemption for every member in your household. Secondly, put aside an additional $100. It allows you, payroll deduction allows you to take an extra whatever you would like to put in for your taxes. But
and how do you do that, Al? I mean, do you talk to your employer about that?
You go to your employer, you go to the HR department in a larger company, privately owned companies, talk to whoever's preparing the payroll, and get that extra money into your taxes, because if you're laid off and then you have unemployment compensation, what's going to happen is the IRS is going to come in at the end of the year, which is right now April 15th, and if you were laid off last year, you've got to pay taxes. And so now you got a tax lien against your assets.
So you're getting your unemployment checks, and part of that is going to go towards paying that.
So one exemption for every member of your household, plus a little extra if you feel that it's necessary.
All right. Well, unfortunately now a lot of people, of course, tempted to tap into the 401k. You say that's a big mistake.
That's a big mistake. If you can at all afford not to take your 401k money, try not to. But there's times you may lose your house, you may need to make payments, this may be the last resource you have. If that's the case, remember that you have to set up an interest rate that is equivalent to what the bank lending rate is at the time that you take the money. So roughly right now, 6% would be what the IRS would consider to be a legitimate interest rate, 5.5, just like mortgage rates. Now, you take that loan and you have to pay it back over 20 quarters, which is 5 years. So at 5 years, you have to have each quarter, you have to pay back a certain amount of money at 6% interest, realizing it comes to you. Now, failing to pay it back, you're in a crisis, you now will get hit with the 10% because you didn't pay it back, 10% penalty, and you will pay ordinary income tax on the balance of the loan.
And is that the same with the IRAs?
Same with the IRAs.
Okay.
But the IRAs are a little bit more liberal. You see, you're not under a constraint to pay the IRA back immediately, but with the 401k, it's a mandatory program. Okay,
and very quickly, because we're running out of time, when President Obama was campaigning, he talked about making it easier for people to go into their 401ks and not getting penalized. Is that going to still be the case?
Well, he hasn't passed that law, and so it's not in effect. Remember, politicians say everything that they can to get elected. Let's wait and see what the final bills are, but that is not in the law at the present time.
All right, Al. Appreciate your time and your wisdom.
Yeah.
All right, see you soon.